Another storyline is the retail credit performance remained stable despite headwinds. And that's a little bit, I think, Todd, you might have touched on the headwinds that the report seems to talk about the past and the future a little bit differently. Any thoughts on retail credit performance, gentlemen?
One thing I've seen that's changed recently is right during the last administration, a lot of student loan debt could stop making payments. But I think that with the current administration now, that's back on. So it'll be interesting to see. I forget how the millions of dollars in student loan payments that are in arrears, how that might impact consumers' ability to make other payments, depending upon where they prioritize, where they prioritize making loan payments. All right. With inflation, the cost rate, that could be a challenge, and that could impact, I think, credit unions' delinquency and potentially charge-offs in the future. Again, the trend seems to be for credit unions, delinquency and charge-offs seem to have leveled off, maybe even down a little bit for this first quarter. But right, there's always, with that student loan potentially hanging out there, that could be a concern. I think that credit unions need to address.
Good point. Good. Todd?
I think the student loan thing is going to be a huge one in the future. I don't know how that impacts, our credit people. It definitely hits your borrowers in those younger age demographics. It's just somewhat interesting, they talk about headwinds and, which way is our economy going? And Trump jumps this way, then that way with tariffs and this and that. Delinquency levels are really manageable. There definitely seems to be a pullback in consumer spending or in bank credit union lending standards, because for both banks and credit unions, auto loan portfolios have shrank a little bit. And I don't know how often that happens. Maybe it was just because there was a huge spike in purchases during COVID, but auto lending numbers did shrink. I tracked unemployment by states, and if you look from December to May, 24 states had higher unemployment, but 26 of them had lower unemployment levels. So everything is kind of mixed and muddled. And if you look at the FDIC's quarterly reports, they break things down by their 5 regions. There's a lot of performance differences across regions. So, there's all these risks that are generic to, our credit unions, but there's certainly different economic zones in different parts of the country are performing very differently than other parts of the country.
We had the sand states in 08, 09, right? That's kind of what at NCUA, it was where there was sand, there was a problem, whether that was Florida, Las Vegas, etc. When you look at the 24 versus the 26 that had up or down, anything pop out at you on an individual state?
I didn't look at individual states, or I didn't look at NCUA's performance by region or states. But when you look at the banks, basically your coast, your San Francisco, New York thing are struggling more than the heartland of the interior. Last time the sand states, my first 4 or 5 years as a DSA, right through that last recession, it was all spent in Utah and Arizona. And I closed a lot of credit unions in Utah, and so did the FDIC.
Steve, Dennis, anything to add here?
The one thing I kind of observe is there's this big differences with all the generations in terms of how they view borrowing and how they're doing their own finances, which will affect future retail loan growth, and to see how credit unions are able to adjust their marketing for the borrowing type generation. We'll see how that behavior is in the future, but it's something they definitely should be looking at.
That's one of the keys. I agree with you. That's one of the keys to long-term survival, figuring out where the borrowers, how they're going to react so that you can make good loans and add to the bottom line.
It's how do you capture them as depositors too? Because they move their money around. How do you get them to use your debit card when, a lot of them use Venmo and PayPal and Apple Pay now. So like the whole payment systems are, circumventing the general credit union and banking industry with these third parties. And, it'll come up later maybe with fraud, because the OCC risk report mentioned some of that. But like Venmo, people under 40, I had a thing the other day, I looked it up, how many accounts there were people that are using Venmo, most of them are under 40. If I go through my history here on Copilot, I can probably find it again really quickly. So Venmo's transactions are up 80% just over the last 3 years. 2025 first quarter year, Venmo did $342 billion in payment transfers between people. And you think of the industry, that's not a lot. And they're not the biggest one. They're just the fastest growing one. But it says 85% of their users are under 40. So
I'm one of the 15% not.
I've used it maybe twice in the last couple of years when I've sold stuff to other people and got an account just for that. It's like, how do Freddie gather up and get these people to become members for their transaction services for those checking accounts and for those deposits? It's going to be kind of somewhat of a challenge, I think.
And by the way, here's my Venmo tip. If you are on Venmo and you don't know that you have to set some privacy things up so that your friends or contacts don't see every time you send a Venmo, you might want to look at your privacy, because my kids tip me off to that. And then there are some other connections I have that are constantly or frequently having payments to or from. And it's something that you want to make sure is not toggled in the wrong way.